Hello, this is Mike Foreman with Game Plan Retirement with another episode of Let's Ask Mike, where I share information I've gained over the years as a retirement plan specialist and also retirement planning specialist, as well as questions that have come up recently. And one question that has come up recently is about 401k loans. So I thought I'd clear up some common misconceptions. So first off, not all companies' 401k plans allow for loans at all. That is a company choice that sometimes they choose not to. So first thing you want to do is you want to check with your human resources department or check your summary plan description to see if loans are allowed. And again, if they're not, there's really not much you can do about that other than ask them to add them. And so if they do allow for loans, then you're going to want to see the loan policy statement, which is going to tell you exactly what they've chosen out of a few parameters. So they may allow for one loan at a time, they may allow for two, or have other direction on that. And typically you can borrow up to 50% of your vested account balance between a maximum of $50,000 and typically a minimum of about $1,000 or maybe two. There's interest, and this will be also explained in the loan policy statement. Basically, the interest has to be based on the prevailing rate of similar type loans. Most companies that I've worked with use the prime rate plus either 1% or sometimes they use 2% over prime to calculate the interest rate. And then if you're borrowing for anything but the purchase of a primary residence, then you can take up to 5 years to repay the loan. So once you make those decisions, and there's several online calculators that you can use to kind of figure out what your payments might be in advance, then you submit a loan application, and a formal version of that is created by an administrator, and it results in an amortization schedule, which is exactly how much is going to come out of your check on a weekly or bi-weekly, however often you're paid basis. And it will automatically be added to your pay, reduced from your pay to pay off the loan. And all that typically works real smoothly. The problems some people run into is that if they leave a company before repaying a loan, they either have to pay off that loan within 90 days of the last payment, or it becomes taxable income. And if they're under age 59 and a half and that has occurred, then there's also a 10% penalty. So in general, kind of a bad outcome. So you want to make sure that you and your friends and your family, if possible, don't leave companies with outstanding loans unless they know they have the money somewhere to repay that loan because of the tax consequences. And so again, sometimes there's that confusion, and I wanted to help do what I can to clear that up to prevent people from having negative outcomes. If you'd like to talk about that more in detail, or if you own a company and you want to talk about your company's loan policy and whether you should allow loans, whether you should add them, whether you should remove them, or anything along those lines, please feel free to reach out. I'm happy to help. And thank you again for tuning in to Let's Ask Mike. I appreciate you very much. Thanks again. Bye-bye.